Hello, and thank you for joining me on the People's Space podcast. The name is Wenson Mavor. Today, we will be delving into the fiscal situation of the country, taking into account the recent announcement from the Ministry of Finance of government's decision not to continue on the extended credit facility program under the auspices of the International Monetary Fund, and to be able to provide some perspectives. And of course, let us in on that is no other than public finance researcher from the Center for Trade Policy and Development, and this is Robert Mwale. Robert, it's great to have you on the platform once again.
Thank you so much, Wedson. Looking forward to a wonderful discussion on the ECF.
Okay, so as usual, I know this is not your first time being on this platform, Robert, but the beauty about the People's Space podcast is that we always have new people watching us on different platforms: YouTube, Facebook, TikTok, X, and all kinds of social media platforms altogether. So there are those that may have missed the memo on who Robert Mwale is. A lot of people know you as a guy that is always there talking when there's something to do with debt, the IMF, and all these big terminologies that people listen to. Who is Robert Mwale?
Okay, Robert Mwale is a second born in the family of three. I have one elder sister and one younger brother. He was born in Lusaka in 1988. I'm also a family man, married to one wife.
Very important, one wife.
Married to one wife by the name of Catherine Mwale, and together we have three beautiful daughters.
That's interesting. Now, having an elder sister, I think that's one thing we have in common. So I think this is not therapy, by the way. So, but we're just comparing notes. Does it still make you feel like? Do they call you like, Robert? There's this. Robert, there's this. Does it still make you still feel like you're the firstborn, being the firstborn man? Somebody told me that being the eldest man, it doesn't matter how many elder sisters you have, you're still the guy.
So technically that becomes a situation. So there are those issues where you just have to be there and address them. So that is one thing that comes with that privilege. But again, it's interesting.
Yeah, I asked that specifically because I thought I was the only one, because sometimes these people forget. I'm like, I'm not the firstborn. You guys are older than me. I've got two elder sisters, by the way. But anyway, getting right into our conversation, Robert, for today, obviously, there's a whole lot that's happening within the fiscal space in our country. And a recent announcement was government's decision not to continue on a successor program on the extended credit facility. And there was a whole lot that was said online, by different people. And to some, it was interpreted as if Zambia had completely walked away from an IMF program. So as we start, first and foremost, give us that clarification. When that news came from the ministry, does it mean we're now out completely on an IMF program? What exactly did that entail?
Okay, no. So what that means that in 2022, in August to be specific, Zambia had actually gotten on an IMF program, and it was supposed to be a 38 months program. It was supposed to end somewhere in October of last year, but because there was a review that was taking place, it was actually extended to go all the way, and it was supposed to end somewhere in the mid of January 2026. And the government had an option to actually extend this program for an additional year. And so before that announcement, government had made its intention known that it was planning to actually extend the stay on the IMF program. But then government came back and then announced that what they have now resolved is that they will not continue on this program, but rather they are in talks with the IMF and they want to go now on a successor program. And the reasons that were extended to the public was that the initial program had actually met the objectives and the purpose it was set out to do. So basically, that is the what government had actually indicated.
Okay.
Yes.
Okay. So I read a statement.
Yes.
Which was undersigned by you.
Yes.
And it had some reservations.
Yes.
Concerning that decision from the Ministry of Finance. Kindly elaborate on that.
Okay. All right. So what you're going to note is that we have a government that initially has given an indication that they want to continue on a program. And then at the same time, we then have this same government that comes back and says, we are not continuing on the program for an additional year. And then they tell us that they are in talks with the IMF and opting for a successor program after the elections, which is August 13 elections. Mm-hmm. And then when you look at the way the IMF ECF program, the Extended Credit Facility program, the way it was tailored, when we when we got onto this program, it was not just any other program, but it became an anchor of our policy. So there were so many things that we are going to dive into that were not all right at the time that we got onto this program. And one of it was that our expenditure was higher than our ability to actually generate these revenues. Mm. And so when we got onto this program, there were some reforms that were put into place that made sure that our expenditure pattern begins to align to how much we are able to mobilize domestically. So our fiscal deficit began to actually narrow down to go towards a position where what we are getting in terms of revenue and what we are spending were almost closer to each other. But when we go to 2024, we noted that there was a slippage in our expenditure. In 2025, rather, there was a slippage in expenditure. That reduction in terms of us spending more, we were on a downward trajectory, but we went back into overspending. And then we have now an election year. And an election year is often associated with fiscal indiscipline, and where we begin to get a bit careless in terms of how we spend, so that you need to please at least some voters. And so there is a chance that then, without us being on this program, without us having a big brother in the name of the IMF policing us in our expenditure, we may go and become reckless in our expenditure. And the gains that we had actually gotten from this program can actually be reversed overnight. And so those are mainly the reservations that we've had in terms of us walking away from the ECF program right in an election year.
I know that you're not from the IMF, obviously, but is the IMF open at the moment, for example, for us, if we went back and said, look, we still want to continue on this particular program, would the IMF be open to that? And secondly, from what you describe, is this a deliberate scheme by government to all of a sudden say, okay, we are in the election year, obviously we need to spend, we need to put some money out there, so let's pause for a little bit and then we'll resume later on. Can we look at it like that?
Okay.
Would one be wrong to look at it like that?
So if you look at the way this the announcement came, is that you have a government that, of course, the 38 months that they have been on the program, they have had that time to assess and to see if the program has actually met its objective. And they even went ahead and actually indicated their intentions to extend the program. And because of that indication of their extension, the intention to extend the program, we saw IMF willing to actually come on board throughout the entire process. So from the end of the IMF, I think their doors remains open. And that's the reason why we are even speaking of a successor program. Why? Because the benchmarks that were set out in the initial program, these we were able to meet. But now what is the issue is that when we walk away from a program in an election year, and then if you note, because of not adhering to some of the guidance that we were given by the IMF, we actually went up in terms of our spending. And to balance up that one, we saw government comes to parliament asking for a supplementary budget in an amount of about 33 billion. And that was actually a deviation from the initial plan by the IMF. And so to actually cover that, there was that indication to say we must put in place some additional taxes that people would call loosely as sin taxes, but mainly those were health taxes, and then you include a bit of taxes on gambling and all those things to try and just close up that gap that we had gone overboard. So basically, when you see the IMF program, it has been our anchor in terms of helping us get back on track. What we must appreciate is that eh, as we go to 2020 in November, when we defaulted on our Eurobond coupon payment, what you notice that in a country where we are, this country, is that when we defaulted on that, Zambia was actually closed out on the international market. We couldn't go on the international market to borrow anymore. What had happened also, our copper prices had actually deteriorated on the international market. And then when you check, copper is our main source of forex. So what that means is that your earnings from copper is now gone down. Putting all things equal, it means you need 64% more of your kwacha to service the same loan that you had gotten in dollar. So meaning you have your loans on your external market increasing by 64% just from the inflation itself. Because now that is what is happening. So because of that, reduction rather in value of your currency, that affects your exchange rate. Now you need more kwacha to actually be able to sort out your debt. And so we got in a situation where now our situation became very bad. And so because our situation became very bad, we had now to ask the IMF to actually come on board because our balance of payment became very bad. We were not able to meet our imports because our import cover was below two months cover. Our currency had depreciated and we needed more of it to service our debt. And those were the problems that we had. And so we now went to the IMF to seek for this program. So this program did not only provide us with the liquidity that we needed in the 1.3 that was rate augmented to 1.7 billion US dollars as a fund that we received. But what that does is that the IMF, in extending those resources, they also proposed some of the reforms that we needed to put in place in order for us then to benefit. And those became sort of benchmarks that we were being weighed upon. And so those are the benchmarks then that the government said, these are the ones that we have been able to meet. And now that we have sort of stabilized the country, the currency is now has appreciated. Our buffers in terms of the reserves have gone beyond 4 months import cover. We are now at a situation where our kwacha is stronger against the dollar. And then we have growth within the country now ticking to over 5.8 thereabout from the negatives that we were. So now we are on a growth path. So we no longer need to be on this project or on this program.
But you see, Robert, then, don't you think it puts us in a position where we risk undoing the gains?
So that is mainly then becomes the concern, because what you notice that yes, we are on a growth path. We are just recovering from the COVID. We had a drought crisis, which in itself affected our energy generation capacity, and that affected our productivity in a sense. We are just coming out of those. And this is when our copper prices are now booming on the international market. But with that boom, mainly, it comes with just a forex to stabilize our currency, even if we don't get so much from there. But we are at that point. This is the point where we need this anchor program because we are planning to go into a growth program. Why between now and the time for the growth program, maintain this program that we are on to ensure that those anchors and reforms still remain in place, so that as we graduate to a better program and now begin to focus on investment and growth, we may not risk unwinding the gains that we've experienced now. So that then becomes the bone of contention. And it is so because we are dealing with not any other year, but 2026, which is an election year.
I love the fact that, I mean, I just like the picture that you're painting, Robert, over here. But there's something that you've subtly mentioned, which I want to let you off the hook on, in case you thought I missed it. You mentioned something very, very important here, booming copper prices, okay? Forex stability as a benefit. But again, you said that may be the only major thing that we get from there. Now, there's a whole lot of excitement out there. I've seen people, cheer, boast about this. Why do you think forex stability is the only benefit that we may get from there? And maybe what can we do to be able to get more beyond forex stability?
Okay. No, so basically, when you look at the way we've structured our mining taxation, I think they are more of residence-based rather than resource-based. So what that means is that countries where these minings are headquartered, they are the ones that benefit more from the booms than countries where the activities are taking place, which are the source countries. So basically, what we then benefit from all these transactions is that there is that exchange of forex that has happened, which then goes to this company. And then these companies, they are just obligated to pay the normal taxes that they pay to us. But remember, we are dealing with minerals that are they are depleting in nature, meaning the same volume of copper that we have this year will not be the same volume that we'll have next year with the mining activities that will take place in between. So what is it that we have to tell our generation 50 years from today that we had the copper? So that is where now the contentious windfall taxes come into play. So how do the windfall tax come into play? Right now, our copper prices in the last 5 months, they have moved on the international market from trading below 10,000 per ton, per metric ton. They are now surging to over 13,800, going to 14,000. So meaning the guys that are in the copper business are making a fortune. So in that sense, if we had the windfall tax in place, at this point when the guys are making enormous profits in the mining industry, we have then that the rate of the windfall applicable. So that apart from the taxes that we are administering, from the abnormal profits that are happening on the international market, we also benefit from there because these are our minerals. And then we can channel that money towards repaying the debt issue that we're talking about.
So, sir, what you're saying at the moment, there's no cut for the Jerabos.
That's the challenge that we have. So you find that that's a situation where we're in. So the thinking is that if we could think in those lines, because what you're going to notice that copper seemingly plays a very critical role in terms of issues around AI, the age that we are in. So thinking of the prices of copper coming down anytime soon, it's not something that we can envision. Copper will still remain a major component in that production chain. And because of that, the prices will still be elevated on the international market. But in that moment when the prices are elevated, it will mean even production of these minerals in terms of mining them is going to increase. And so if that mining activities increases, even the depletion rate of those minerals is going to increase. So now, if those minerals then depreciated, they get depleted in the next 30 years. And then we have a generation coming in 50 years from today. And then we begin to tell them the tales that at one point, Zambia was one of the largest exporter of copper, and they still see infrastructure that does not correspond to the story. They still see a road network that is very poor. They still see a country that is far away from attaining sustainable development that will transform lives of its people. And what story are we going to tell? And so because the world understands the dynamics, that's the reason why right now we have also issues around the Robito corridors, where you want to escalate the movement of your raw materials out of the country, when these are the same resources that we can actually use to get the much needed funds that we need to actually repay these loans, as opposed to ask for 1.7 billion US dollars from the IMF.
You are watching the People Space podcast with me, Winston Mavoro. My guest today is Robert Mwale, all the way from the Center for Trade Policy and Development, and we are discussing the fiscal situation in the country, looking at some of the leading trends, such as the decision by the Ministry of Finance to be able to discontinue the extended credit facility program under the auspices of the International Monetary Fund. But beyond that, we're also looking at some of the global trends that may have a bearing on our fiscal outlook as a country. Before we take a break, let me remind all of you that you do stand a chance to win some amazing and fantastic prizes, courtesy of the Center for Trade Policy and Development. All you simply have to do is be active on our platforms where we broadcast the People Space podcast. That is Facebook and YouTube under the handle the Center for Trade Policy and Development, and CTPD Zambia on X, TikTok, and other similar platforms. If your comment garners enough traction, you might just be that lucky winner that may walk away with amazing and fantastic prizes. And by the way, as the new year starts and advances, we have also advanced on our catalog of prizes. So if I were you, I would not waste time and be active on those platforms. See you shortly after the break.
Hi, I'm Baita Maka. Join me on the People Space podcast as we discuss the Tobacco Control Data Initiative.
Welcome back to People Space Podcast. We are looking at the fiscal situation in the country, taking into account the developments with regards to the International Monetary Fund as announced by the custodians, which are in this context, the Ministry of Finance. And my guest is Robert Mwale, who is a public finance researcher from the Center for Trade Policy and Development. Robert, before we get into the other aspects of our conversation, we did stop on, looking at, the copper prices and the dynamics on the international market and how they impact on our country. And one of the things that caught my attention recently was an announcement from Ghana, which is one of the leading mineral producers on the continent, where they've taken a positive stride with regards to value addition in their gold sector, where they will now start processing the resource locally with the view to boost revenue and other economic trickle-down benefits in there. Do you think value addition would be the game changer for us even as we are in this era of surging copper prices?
Definitely. So what you're going to notice that right now, as we export our minerals in raw form, we are actually exporting jobs. We are actually exporting a lot of opportunities within, and they go with the raw materials. But what will happen is that if you decide to add value within the country, what you're going to have is that in that chain, you need to employ more people, and then of course you have suppliers who come on board. And so you have created indirect jobs, and those suppliers are sitting with employees in their offices. So what you're going to see is that there will be now local beneficiation in the process. So that is the missing link in actually us being able to benefit more from our own resources. So it's a matter of, we already have these policies in place. It's a matter of now the issue of us implementing them. Once we do that, we shouldn't be able to just look at forex as the only thing that we benefit from these our minerals. Let us be able to create proper jobs for our people through value addition. Let us also create more opportunities for the suppliers, for businesses to thrive, and for those that are under those businesses to benefit. And what you're going to do is that it does not only does that, but what you've done essentially is that those more employees will pay more taxes to government. Those businesses will also remit revenue. So you also have your domestic revenue mobilization base not only widening, but now you're collecting more. With the more collection, you can now spend more on health, spend more on education, spend more on improve the quality of life. And that is how countries then attain what is called a sustainable development. You've moved away from just the numbers in the growth, but making these numbers a reality to those that are the people that you're actually saving.
Now, when we talk about, election year, Robert, a lot of people look forward to election year because, in lack of a better term, I like using the analogy of the Ugandan finance minister, Mr. Kasaija, who likes saying, the economy is booming, it's, yeah. So there's a whole lot of activity that happens. Money is released, campaign materials, people benefit, companies are formed. There's a booming of some sort that happens because of the spending, because of the capital injection into the domestic economy. And people look forward to that. On that, this election spending cycle, why should it be of a particular concern when it comes to the IMF program, vis-a-vis the ease discipline that you spoke about earlier on?
Okay. So what you're going to notice that, like I had stated earlier on, is that an election a year or election cycle normally weakens the fiscal discipline within the country. Mm-hmm. So what you're going to have is that you have expanded sort of expenditure on issues around your subsidies. Mm-hmm. You have expanded expenditures on issues around your wages, as well as also your social expenditures. These were actually embedded already in the ECF program, but then you commit more to these. And then, so with that risk that is there, you will risk now going into expenditure slippages. So what I mean by expenditure slippages is that at the beginning of any budget cycle, a fiscal year, the government will present a budget to Parliament and says, this is our intention on how we want to do it, to spend this money this year. And so they will actually give us estimates of how they want to spend that money. And then you find that when there's that expenditure slippage, what normally suffers is the capital expenditure side. So you're going to move your funds from where you had initially planned. And because you've overspent, where are you going to get the extra funds? before you actually go on the domestic market to borrow more, what you will note is that you begin to rearrange your budget. So you find that what suffers the most is the capital expenditure side. So the capital expenditure side is where you have planned to construct roads. This is where you've planned to put up more schools. This is where you've planned to put up more healthcare infrastructure. So you will then move those monies to support this social agenda. And then what you're going to have ultimately is that the developmentalists will tell you where a good road goes, development does what? Follow. So you find that when you have not invested in proper infrastructure, you are not able, in essence, to attract investment. And private investors are the ones that actually drive growth. And so if you do not have then the private investors, your economic activities becomes relatively lower. And if your economic activities become relatively lower, the effects, you have the ripple effects to that. You have lesser taxes being limited to the ZRA. You have fewer people being employed. And then you have all those problems that now come into the country. So then, despite the gains that people see here and there on the social aspect, there are now these consequences that will come in, and ultimately, to supplement that deficit, government will go on the domestic market, borrow more resources. And when they borrow more resources on the domestic market, you have a situation where you are now eating now and assuming that the future generations are actually going to bear this burden. And then you are actually putting a country in a cycle of debt. And as long as the country remains in the cycle of debt, it's more like in a home. As long as you remain in a cycle of debt in a home, you cannot have resources to buy a plot. You cannot have resources to build a house. You cannot have resources to grow and develop as a family. And the same analogy then applies in a context of an economy.
So when we talk about the decision to momentarily be out of an ECF, an IMF-backed ECF, how does this signal, when it comes to our ability? Remember, we are still an indebted country. We're still in talks. We're still involved in debt restructuring talks, which are still ongoing. And we've made some meaningful gains on that. But going out of an ECF, what sort of signal doesn't this threaten our credibility? Doesn't this make our creditors go like,
Okay, so what you're going to note is that by being on the ECF, there are the gains that we've actually.
Because the key thing you mentioned, Robert, was fiscal discipline.
Yes.
Which is something that the creditors obviously are extremely interested in.
Yes. So not only have we become so disciplined in our expenditure, but the reforms from the IMF indicated that we needed to make reforms in our revenue, in our tax revenue authority. So you have issues of digitalization. We became more efficient to an extent that between 2021 and 2026, our gross revenue collection has doubled from almost 83. We are over 165 billion. And then in terms of just the GDP, that collection in terms of as a percentage of GDP, we've grown from 20.4%. We are heading towards 23%, meaning what is coming back from what we are producing within the country in taxes is now increasing. So because we've put up systems that have been supported and spearheaded and superintended upon by the IMF. And so now, people argue, no, being out of that program, these are things that we can continue on. But you see that the challenge that we have is that our revenue side of things is relatively inelastic, meaning we cannot increase our revenue collection in as much as we would decide to increase our expenditure. So we cannot say if we are able to collect 168 billion of taxes, next year let us collect 300 billion. It will not happen. You need a lot of infrastructure in place. You need a lot of things to do. And then if your base has been made, if what you have is your revenue base, the only thing you can become more efficient and collect a bit more. So you find that the growth on the revenue side is taking a tortoise space. But on the revenues, on the expenditure side, you can woke up from a dream and say, the budget next year, we want it to be 400 million. And you have the ability to spend the 400 million. And then you say, where do we get the extra? We go and borrow. And if you do not have someone to put those controls in place, you have debt funding the excess. And that now begins to manifest when now you go and want a successor program. You find that all the gains that you had achieved under the initial program have been eroded. And that what we must bear in mind is that still our debt carrying capacity is weak. So immediately we take missteps here, we get back to a place of insolvency.
So you've mentioned something very, very interesting. And the Minister of Finance is on record talking about Zambia's debt approach, which is concessional. And, you know, the gains have been explained, you know, what we stand to benefit as a country with regards achieving fiscal stability and balance. And another thing that you've mentioned in your submissions, Robert, has to do with if we are borrowing concessionally, if we say we'll not go out there to commercially borrow and do all these things, definitely we still have to spend. And where do we go? We go to the domestic market, okay? So are we striking a proper balance at the moment with regards concessional borrowing, going to the domestic market to borrow, okay, which is obviously crowding out the private sector, and at the same time, we are eroding our ability to have a thriving manufacturing sector as a result of a thriving private sector. So how do we achieve fiscal balance in all this if, like you rightly said, our ability to spend is always not a problem, but our ability to generate is what seems to be facing threats, not only from outside, but even from ourselves?
Yeah, so basically what you're going to see is that clearly, like you've put it, is that the challenge that we normally have is that how do we attain this balance? So now the balance then is only cemented in fiscal consolidation. So how do we mean by fiscal consolidation is that we need to move our expenditure pattern from where we are to start moving closer to how much we are able to mobilize domestically. So meaning how we do that is that if our ability to collect, currently we are sitting at, our projection for next year is that our current ability to collect as a percentage of GDP will be 23%. And where we are currently as our expenditure as a percentage of GDP is 27%. So there's already a 5% deficit there. Is that since revenue is moving at a tortoise pace, the only thing that must be moderated is the expenditure. So we must begin to align this expenditure to come closer to what is realistic to what we are gaining. And so as we align that expenditure, as we reduce the gap in between, it means even our borrowing needs, our financing needs are going to be reducing, meaning we'll not be borrowing as much as we should be borrowing each year on the domestic market, thereby freeing up the resources that must be now be borrowed by the private investors that must invest in the manufacturing and grow the economy. But as long as government's activities on the domestic market are increasing, the players on the market look up to the government as this guy that regardless of what happens, he's likely going to pay us. So meaning they will always prefer to actually do business with the government as opposed to doing business with a private investor. And ultimately, you have the private investors being choked out of the business. And then in the long run, you have now growth slowing down. And those are the problems that we do not need. So to strike a fiscal balance, we must then begin to be moderate in our expenditure, ensuring that we need to move towards our ability to raise revenue, so that as the two lines then converges, then we will have no need of actually going on the domestic market. The understanding is that, yes, we cannot get to a point where we are spending 100% of our budget is financed by what we are able to mobilize domestically. But what we are saying is that how much we borrow on the domestic market, we must be able to move towards a certain level where we, as much as possible, closer to how much we are able to raise. And that then puts up some balance in terms of us actually spending and how much we're getting into debt. And then we free up the market for the private sector to thrive.
Briefly, Robert, in view of the gains that you've mentioned, which we, benefited from being on the IMF Extended Credit Facility Program and various other, reforms that are helping us to get back on track, fiscally speaking, are we still at risk of debt distress? Are we out of, shouldn't we worry anymore about debt?
So our debt carrying capacity is still weak. So what that means is that we are still in places where we are being looked at as a country that has no ability to repay its obligations in the long run. So we are still there. So what that means is that if there's any shock, so this could be a drought. If we have a drought in the country where production goes down, we go back into default. If we have prices of copper on the international market dropping, meaning our forex reduces, we've tempered our forex, and then we go into default. So we are still in the waters. We are not yet out. So that is where we are in terms of how we are currently. So we have not yet come out of where we must be. So that's the reason why, if you even look at our rating, it's still showing that we are still in places where if any external shock could hit us, we go back into our debt default settings or levels. So it is then becomes important that we still need to navigate and move cautiously so that the gains that we've had, these ones now be sustained. We must move away from growth, go to resilience, and then when you get to resilience, transform that into now development that is more sustainable so that we are able to actually support the budget domestically, we are able to meet our debt obligation, and we are able to still be able to provide all the essentials that are needed for our people within the country. And that is the thinking that we must be having.
Finally, Robert, as we get to close our conversation, what can you say is the single most biggest lesson that Zambia has learned from its engagement with the IMF under the ECF? And coupled with that, I would also like to get your thoughts on what policymakers can do to ensure that the gains that we've achieved under the IMF program are sustained in the long term, vis-a-vis the current decision that we've made.
Okay, so I think the single most benefit that has come from us being on the IMF program is the reforms that the IMF has actually put in place in how we conduct our business in terms of contracting loans in future. So we have issues like the Public Debt Management Act. That is a reform that is come in place, where now we can no longer sit in some office and agree how much debt to contract. Now we need to go through Parliament. There must be some sort of transparency. Parliament must know exactly what government is borrowing, and then we have that approval process. And not only that, there is also a demand that has come with that reform, where government has to periodically, within a space of 3 months, I put up a report of how much additional debt we've accrued, how much we have paid, and so that there is that sort of confidence. We know we are able to track the debt profile. And also we are also working towards the state enterprise reforms, because in the past you have the state enterprises actually contracting debt, and you have this debt in an event where they default being borne by the government. And so you find that not having those ones in a formal contract or in your formal debt portfolio does not give a clear picture of your fiscal position. You cannot do meaningful stress testing to know whether you are able to respond to a shock or not. You cannot do a proper scenario analysis because you have debt by state-owned enterprises that have been contracted that the government is not aware of, that are hidden. But when those data defaulted, they come on side of the government, and that has still remained a weakness. And it's what we are hoping that as we try and do these reforms, we must actually normalize that so that we are able to have a proper fiscal position. And then the other potential risk that is actually coming, just to mention, is the private, the PPPs, the public-private partnerships that we are getting into. Those are sort of off-balance loans. These are loans that will not show that government is owing this amount because they are not on the balance sheet of the government. And so you do not really get to have the clear picture of how much you owe as a country. So there are some mechanisms that have actually been put in place. Besides having a debt office, we now have a PPP office so that we are able to track all those things. And those are all part of the reforms to ensure that this is actually noted. So that is one of the most gains that we've gotten from this program. We can today, if you want to know how much Zambia owes, you can simply go to the Minister of Health, Minister of Finance and National Planning website. You should be able to find exactly how much government owes. You're able to know how much we paid in interest in this quarter. You're able to get all the details that you want. And so that then brings in confidence on the part of the investor. The investor now has a true picture of where Zambia stands, its ability to raise revenues, and they can now make decisions whether to continue on to invest here or they cannot invest based on their risk assessment. So that then puts up confidence in these investors to deal with us. And so those are some of the things that we see that the program actually came with. And those are the benefits that we must actually embrace and ensure that even beyond the program, they become part of our fiscal public debt management agenda, so that those are critical if we should have a country that talks of controlling its debt contraction as well as growing the economy.
Thank you very much, Robert, for coming through to the People Space podcast.
And thank you for having me.
My guest, ladies and gentlemen, has been Robert Mwale, all the way from the Center for Trade Policy and Development. He is in the public finance space. He is leading research over there. And today we're looking at some of the aspects of the Zambia fiscal management, vis-a-vis the decision by the Ministry of Finance to be able to momentarily discontinue the extended credit facility program, which is under the International Monetary Fund. How this affects the country in the long term. Is this the right time for Zambia as a country to be able to make that decision? And Robert was weighing in, providing us some, thoughts on that particular account. But beyond that, also looking at some of the strategies, some of the policy directions that we can consider as a country to be able to strengthen our fiscal position vis-a-vis decisions like the one that the Minister of Finance just announced. And on this note, this is where we end today's edition. And of course, before I let you go, I would like to post a reminder that we would want to know what exactly you feel about some of the conversations that we're having on the People Space podcast. And most importantly, remember, it's called the People Space for a reason. So it's not for us to just converse, but it's also for us to get to hear from you. So we'd like to know what you think, what your thoughts are on this important topic of conversations that we do tackle. And most importantly, even some of the guests that you would love to see on this platform, we do also want to extend that liberty for you to make those suggestions. And remember, with the comments regarding the topics, if one of those gets more tractions, it does stand a chance to make the author win fantastic and amazing prizes ranging from t-shirts, capes, mug cups, hoodies, and various top-notch quality materials that we have for giveaways on this particular platform. So let's get talking, let's get interacting. See you next time. And remember to like the pages where we also broadcast the People Space podcast under the handle the Center for Trade Policy and Development and CTPD Zambia on various social media platforms. See you next time.